You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. What about you could create a dividend income stream from your portfolio that would be sustainable throughout your entire retirement, and that you could even leave money for your children or for your spouse and everybody that you love? Sounds pretty appealing, right? And a lot of investors will think of like relatively high yielding stocks, and I'm trying to debunk this. I'm trying to highlight how like the power of investing in low yield, high dividend growth stocks versus the high yield, typical dividend investor. And to do that, and when I celebrated the 10-year anniversary of Dividend Stocks Rock last year, I wrote a guide called Dividend Income for Life. And in that guide, I explained and I showed like 24 popular stocks at DSR back in 2013, 2014 that had a high yield. And to qualify high yield, I just set the bar at 5%. So we could debate that all day. I decided that 5% and up is a high yield. You may agree or not, but I mean, in the 4, I would say it's mid yield, like 3.5 to 5% mid yield, under 3% low yield. Maybe we could agree on that. In that guide, every low yield is actually under 2%, and every high yield was higher 5%. So I went back in time, looking at like the newsletters, emails from our members, and that's great when you have like 10 years of history, right? And I create that guide. And good news for you, you can actually download this guide at moosemarkets.com/income. In that guide, you will find this previous kind of like study, but I mean, of course, it's just like 48 stocks. It's like 24 high yield versus 24 low yield, but the results are incredible. Like the difference between both, it's like simply telling you that if you focus on stocks paying a yield above 5%, you put your retirement at risk. Like, not that you're going to underperform. I mean, that's fine. I mean, you know, if you underperform the market, but you have enough money to live on and you have a good dividend and you don't worry about your portfolio, that's not a problem. It comes to become a problem when you have dividend cuts, when your dividend doesn't keep up with inflation. And then when you're trying to sell your shares to buy something else, you're actually losing capital. So therefore, your retirement is at risk. So a lot of investors were saying last year, well, that's very interesting, but that's kind of like cherry picking a little bit. You're looking at the past. Hindsight is 2020 back then. And I'm like, yeah, totally fair. You got it. You're right. It was a good attempt, but it's not perfect. Definitely not. So starting in January, I actually offered my DSR members a list of low yield, high growth stocks versus high yield stocks. And again, I did a lot of work to find high quality, high yielding stocks. So I did not pick like companies that I didn't believe in, or like poor REITs that I knew that there was a high chance of a dividend cut. I really picked like very, very solid companies. And today I'm doing like, it's almost 1 year results. That is actually, those results are actually included in the Dividend Income for Life guide now. So you can download it for free at moosemarkets.com/income, which is going to tell you a lot about that strategy, but also a lot about what's going on with those low yield versus high yield. And after almost a year, I mean, no surprise here, all stocks performed well. High yield, low yield, mid yield. I mean, a monkey, like, let's be honest, a monkey would have made money on the stock market this year. I mean, if you're not in a positive territory today in 2024, you really have to review your investment strategy, because everything is it's kind of like trading at an all-time high at this point. It's even harder to find good deals on the market for that reason. So you have to dig a little bit deeper. So long story short, everybody is happy today. Still, the low yield, high growth stocks on the Canadian side did better by 2.5%. So what does that mean? Well, it means that it is an outperformance of actually 16%. So when you compare the both results, the low yield Canadian stocks did 17.70% total return versus 15.2 for the high yield. So you're going to tell me, but Mike, that's not a problem. I mean, 15%, I can retire on this every day of the week. And I totally agree with you. But I have to say, that's first, it's like just 1 year. It's like either luck, either bad luck. 1 year return means absolutely nothing. But I needed to start somewhere, right? Because if I look at the past, it's not worth it. And if I look at the future, well, I need to start at one point. So we have 1 year. Next year it's going to be updated, and the following. So maybe in 5 and 10 years, we're going to have like an amazing result. But so far, the low yield is winning on the Canadian side. 17.7 divided by 15.2 gives that 16% outperformance. On the US side, it's a little bit less. So it's 20.6% versus 19. So 1.6 improving. So roughly 8% better. So still 2% average better performance on the next 20-25 years of your retirement. That's going to make a huge difference. And also keep in mind that right now, everything is going up. So when I look at the specific results, and if you're curious about the list of stocks, they're all there inside the guide. So at moosemarkets.com/income, you can download it and you'll see all the stocks. We're going to talk about a few of them today. But I mean, 10 minutes goes fast. I have like 48 stocks to cover. Not going to happen, right? So on the Keen side, I had two -1 Couche-Tard. I mean, big surprise, right? ATD's down almost 7%, and Canadian Natural Railway down almost 5%. On the Keen side, for the high yield, I have also two negative companies. So BCE -11, including the dividends, so definitely a bad year for this one, and TELUS at -4.5. On the US side, it is also very similar. So the one negative, that is Nike at -19%. Definitely a rough year for this one. So that was a tough selection for this. And on the high yield, we only have Ford at -1%, which is pretty solid. Once again, you're never going to see which companies are performing well during a bull market. We're going to see who's swimming naked during a bear market, and we all know that. So far it's interesting, but it's not complete. However, I was quite surprised to see a lot of companies offering like 30, 40, 50% return. So in the 30-ish return, we find Brookfield, CCL Industry, Dollarama at 41 on the Keen side. On the US side, for the low yield, we have Broadcom at 56, Costco at 33, Lemite Vascular at 65, Tractor Supply at 34. So a lot of high performer in the low yield side. Ironically, we also had very good picks on the Canadian one. So I've picked Capital Power, which I have in my Smith Manover portfolio. This one is up almost 42%. CIBC, surprisingly, I mean, up 39%. I kind of have that guess that a lot of investors and banks starting to sell their TD shares and going for like either Scotia and CIBC that were like underperforming the market for a while. But maybe there's like a movement of capital. That would be interesting to see if people selling shares of like BMO or TD that because they're having a rough year are moving their capital towards other banks. But I mean, even Scotiabank was up like 20% when I did those results as of October 10th. On the US side, we find Altria, MO, quite surprising there because this one I'm not in love with, but I know it's quite popular in the States, so that's why I've picked it up. Annan Armstrong, ASI, up 53%. 3M coming back from the dead at up 45. So those are like related a little bit to timing, and I don't expect them to keep on growing that fast. Of course, I'm not expecting Broadcom to keep up growing at 56% per year either. I'm not stupid. But yeah, so it's an interesting starting point. I think it's going to be more interesting moving forward. Two other things that I include in that guide, though, that will be of high use for you guys is I show you an example of how I would build a $1 million portfolio, including the strategy to generate enough income at retirement. So if you need 5% or $50,000 per year to retire from a $1 million portfolio. So again, you can download it at moosemarkets.com/income. So it's free. If you're already on our mailing list, you're going to receive it this Friday, so don't worry about it. And yeah, so tomorrow we're going to look a little bit more on why companies are paying high yield. Companies, some income funds, and covered call ETFs. So we're going to look at the mechanic behind a high yield or a high distribution. All right, Moose, that's enough for today. We're going to talk again tomorrow. And until the meantime, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.